Not deducting losses. A prominent tax problem for investors and traders occurs when they're unable to deduct trading losses on tax returns, significantly increasing tax bills or missing opportunities for tax refunds. Investors are stuck with this problem, but business traders with trader tax status can avoid it by filing a timely 475 election for business ordinary tax loss treatment. First, learn about the capital loss limitation. By default, securities and 1256 investors, futures traders, are stuck with a capital loss treatment, meaning they're limited to a $3,000 net capital loss against ordinary income. The problem: their tax losses may be much higher and not used as a deduction in the current tax year. Now, capital losses first offset capital gains in full without restriction. So if you have $100,000 of capital gains and $75,000 of capital losses, your net is $25,000 of capital gains, and that's what you report on. But in the reverse case, where you have $75,000 of gains, $100,000 of losses, you have a minus $25,000 net loss. You're limited to $3,000, and you carry over $22,000 to the next tax year. So there is a deferral, but that can really cost you. After the $3,000 capital loss limitation against other income is applied, the rest is carried over to the following tax years. Now, many traders wind up with little money to trade and unused capital loss carryovers. Some, it can take a lifetime to use up their capital loss carryovers. Hopefully you will get back and have capital gains in the near future and use them up. Now, if you're trading futures, 1256 contracts have a unique rule, a special 3-year loss carryback election that you file on a timely filed return to carry back 1256 losses on Form 6781 only against 1256 gains in the prior 3 years. Otherwise, there are no opportunities to carry back capital losses. You're stuck with carry forwards. That was the first limitation that you need to be aware of. The second one is wash sale losses. A securities investor who buys back a substantially identical position 30 days before or after taking a capital loss must add the loss to the replacement position's cost basis. If you're an active trader, this is very common. You take a loss, let's say in Apple equity, rare these days, just kidding, and then buy it back within 30 days. The IRS doesn't consider that an economic sale. They feel you got back into the position, so you shouldn't take the tax loss. You should have to defer the loss to the replacement position. Now, it gets a little complicated. Inside or between taxable accounts, the problem really exists at year end, because take a loss in December and buy it back in January within 30 days, you have to defer the December 2018 loss to January 2019. So it's really a deferral problem, which can be very annoying and costly, but not unconscionable. It gets worse, and this is what most people don't realize. When you buy back a losing taxable position inside an IRA, so you sell it in your taxable joint individual account and you buy it back in your IRA or your spouse's IRA or Roth IRA, it's a permanent problem. There's no way to defer the basis to the taxable account because you bought it back in the IRA. So you never get the loss in your taxable account and you never get the loss in the IRA. There's no way to record the basis. What most local accountants and taxpayers don't understand, some brokerage firms either, is that the rules differ between brokers and taxpayers. Broker 1099-Bs, they handle wash sales, but in a restricted manner, in compliance with the IRS rules for brokers. They don't handle wash sale losses across multiple accounts or on substantially identical positions, but the IRS requires taxpayers to do so. Multiple accounts means your account, your joint account, your spouse's account, the IRA accounts. A 1099-B is only wash sale adjustments on the one account, not between brokers. They don't communicate. Now, also, substantially identical positions mean between, for example, Apple stock options, and Apple stock options at different exercise dates. They're all substantially identical, but the broker only does it on identical positions. Now, most local accountants are not aware of these differences. Doing it correctly with a software like TradeLog may be better for you or worse. It may uncover more wash sales, or it may make more wash sales melt away with gains inside of another account. Wash sales apply to securities, not to commodities, futures, cryptocurrency, which is currently not considered a security. So it applies to securities, equities, equity options, and there's plenty of other types of securities too. Securities traders, and this is the big lesson of the overall lesson of trader tax status, is that securities traders eligible for trader tax status can file a timely Section 475 mark-to-market accounting election statement, and that makes them exempt from wash sale loss adjustments and exempt from the capital loss limitation. I call it tax loss insurance. Now, if the IRS does not label a financial product a security, then wash sale loss adjustments should not apply. That's the case for cryptocurrencies and exchange-traded notes, ETNs that are structured as prepaid forward contracts. If it's an ETN debt security, that's a security, and a wash sale applies. So now that you know about wash sales, don't let yourself fall into the trap of incurring many throughout the year with an IRA and at year-end in taxable accounts, and get a nasty surprise when the 1099-B comes showing $500,000 of wash sale loss adjustments at year-end. You can avoid them to begin with in this manner. First, break the chain on wash sale losses at year-end in taxable accounts to avoid wash sale loss deferral to 2019. For example, if you sell Apple equity on December 20th, 2018 at a loss, don't repurchase Apple equity or Apple equity options until January 21st after 30 days. And that avoids the 30-day window. So the loss will be allowed in December, and you won't have to defer it until the next year, 2019. So you can have wash sales throughout the year, but that's okay. What matters is, can you take the loss in 2018, or do you have to defer it until 2019? Again, next best way to avoid wash sales is with a 475 election. Maybe you missed that deadline as an individual, which was April 17th, 2018 for 2018. You can stop trading an individual account, form an entity, elect 475 inside the entity within 75 days of inception. That breaks the chain on wash sales in your individual account, so you won't have a year-end problem. Now, when you think about the taxable account and the IRA, consider a do not trade list. Trade tech stocks in your taxable account, but don't trade those same tech stocks or options on those tech stocks inside of the IRA. They're on your do not trade list. That avoids the inadvertent triggering of a permanent wash sale loss problem, which is catastrophic. Again, most local accountants don't know about it, don't deal with it. They just download 1099-Bs. If the IRS catches up with you, it could be a nasty audit with a big back taxes, interest, and penalties. So I encourage you to do it properly. Understand and avoid wash sale losses when it counts, during the year in taxable accounts and throughout the year with IRAs. Determine if the wash sale causes phantom income and additional tax liability. Local accountants rely on 1099-Bs, and you cannot do that if you have multiple accounts and/or trade equities and equity options.